A fair value gap forms when institutions inject a massive volume of orders at a specific moment. This rapid move leaves gaps in the structure because the opposite orders didn't have enough time to get filled. It's like the smart money pushed the price too fast, creating an imbalance they'll come back to correct later. This pullback to FVG often presents institutions with an ideal opportunity to reposition, while individual traders mistakenly believe the market is turning around. Hey traders, it's Max Take Profit here. Today, we're going to discuss an often overlooked yet fundamental concept in ICT market reading, the fair value gap, or the empty space left by price. The fair value gap highlights areas where institutional orders remain unfilled. As a result, the market frequently revisits these areas before continuing its trajectory. Video objective: understanding fair value gaps to elevate your trading skills. Defining and explaining the concept of fair value gaps. Analyzing why fair value gaps form in the market. Using fair value gaps to identify market reversal and continuation zones. Integrating fair value gaps into an effective ICT trading strategy. If just one of these points interests you, trust me, you're going to love what's coming. Stick around till the end and don't forget to like, subscribe, and hit the notification bell so you don't miss out. So what's a fair value gap? It's essentially a supply and demand imbalance that occurs after a sudden and significant price move. Check out what happens when a strong bullish candle forms. It jumps over several price levels without trading them, leaving a gap between the high wick of the previous candle and the low wick of the next candle. This gap is what we call a fair value gap. In simple terms, it's an area where the price hasn't found equilibrium, and since the market always seeks to balance trades, it often comes back to fill this gap before continuing in its original direction. Now that we know exactly what a fair value gap is and how it forms on the chart, let's explore together why the market creates these empty spaces. Because understanding the cause is what makes all the difference between a simple observer and a true institutional trader. A fair value gap forms when institutions inject a massive volume of orders at a specific moment. This rapid move leaves gaps in the structure because the opposite orders didn't have enough time to get filled. It's like the smart money pushed the price too fast, creating an imbalance they'll come back to correct later. This pullback to FVG often presents institutions with an ideal opportunity to reposition, while individual traders mistakenly believe the market is turning around. Okay, now we know why fair value gaps appear. But the real question is, how do you know if a FVG is truly valid or just market noise? Let me show you exactly how to spot a strong FVG, the kind that smart money actually respects. To identify a clear and reliable FVG, you need to check three simple conditions. 1. A strong impulsive candle, bullish or bearish. The more aggressive the move, the more significant the imbalance. 2. A gap between three consecutive candles. The FVG is located between the high wick of the first candle and the low wick of the third candle. If there's a visible space between them, that's a true FVG. 3. Not yet filled by price. As long as the market hasn't returned to fill that area, the FVG remains valid. Before we move on, I want to make sure you're already starting to spot a fair value gap correctly. So let's do a quick test. I'm going to show you 4 different setups, and you'll have 4 seconds to tell me in the comments which one shows a valid FVG based on what we've just learned. Ready? Watch carefully and drop your answer below. Now that we know how to identify a valid FVG, there's one last crucial thing to understand. What happens when the market comes back to fill that gap? And that's exactly what we're going to cover in this fourth point. Now let's see how to trade smartly with FVG. Case number 1, bullish FVG, bullish gap. The price pushes up strongly, leaves an imbalance, then comes back to correct before continuing higher. You're looking for a buy entry when price returns to the FVG zone, preferably in confluence with an order block or a break of structure BOS. Case number 2, bearish FVG. The price drops sharply, leaves a gap above, then retraces to fill it before dropping again. You're looking for a sell entry as price fills that FVG zone. Always combine it with a break of structure to confirm the direction and a liquidity grab just before the move. Note, FVG formed on higher time frames, H1, H4 daily, are more reliable and tend to be respected by the market. On lower time frames, FVGs are plentiful, but only those that are clear and aligned with the broader structure hold significant weight. Now you know what a fair value gap is, why it forms, and how to use it to anticipate institutional reversals. If you want me to show you how to combine a FVG with an order block and a liquidity grab in a single setup, tell me in the comments with the word FVG strategy. Don't forget to subscribe to Max Take Profit, leave a like if this video helped you, and I'll see you in the next one, where we'll talk about another powerful smart money tool, the breaker block.